Rohit Srivastava is with us here in our studios. Rohit, welcome back. Good to have you here as always. I just want to start with both these TCS and HCL Techs, HCL Tech, which are both selling off quite a bit. What do you make of the cart and where can they head in your assessment?
Well, these are among the top performing stocks of the last quarter and mostly exposed to the global scenario. And I would have thought that they would have reacted long ago to the general selling in the US technology stocks, and that did not happen. So probably they've taken these marginally negative surprises as a reason to sell. But apart from that, my sense is that somewhere this sector has to align with what is happening around the world. You had a major tech rally and you're getting a major sell-off. I have not seen a time where you've seen such a big deviation, but we've had one where these stocks have done particularly well for quite some time against whatever has been happening on the Nasdaq.
So you're saying that divergence is getting corrected now?
I think so. I definitely think so, and it needs to.
So you're approaching it from a slightly bigger global perspective, right?
That's right, because I don't think whether a one-day reaction on a particular quarter's results really makes that much difference to a long-term investor. I mean, someone who's held it and it's up 30-40%, would he really be thinking about the stock being down 5-6%? Probably not. He would really want to know whether this is a major top, it's going to decline much more, another 20% from here or not. And that's the kind of answer that you don't usually get from most people who are tracking, because most of the tracking from the fundamental side ends up happening on quarter-to-quarter earnings, and all the views are based on that. They're really not based on the macro trends around the world.
But if you're up 40% and you see a 10% drop, right? I don't think if you'd think of selling immediately, but you'd wonder whether for a name like TCS, which has hardly seen 8%, 10% corrections after results reports, that streak is over, and whether one should be a little cautious, wouldn't you?
No, not necessary, because we've seen those kind of corrections before. We've seen it in Infosys, and then the stock goes on to make a new high months later. So you can't really respond to that. In fact, a lot of people who are genuinely interested might actually think that the correction is a very good entry point. They're getting the stock cheaper and it's still going to grow over a period of time. So they might actually look at it as an entry rather than as an exit signal.
Yeah, I mean, it could be possible. What did you make of the DLF crash, Rohit?
We were very much expecting it because I kept writing about DLF in some very long-term analysis on stocks over 2 months back. And it looked like it would drop. And as it did, the larger structure was one which was indicating to me that it would go sub 100, maybe go as far as 75 rupees. That's my current potential target on the stock. And what I didn't expect it that it would happen on that sudden news. So definitely at that point of time I was not expecting it. I had a larger pattern in mind. In fact, I can admit that 2 days prior to that announcement I actually cut shorts because we were making a good return on it. So definitely I wasn't expecting an event to show up and drive it down, but the larger picture was clearly on the downside, and it still remains.
Okay, 106. But here, if you're a long-term investor like with TCS, HCL Tech, this wouldn't be a good buying opportunity, right, Rohit?
No, definitely not. I think, like I said, my target's currently indicating 75. And generally, I think reality stocks are in a downward trend. So it's not just DLF. You're seeing prices go down even in IBReal, HDIL, some of the key real estate stocks. None of them have really done well since 2009, and after each rally they tend to sell off much more sharply than the market, and that remains the case. So they are generally in a downward trend because of the huge debt overhang.
I want to put out some data, and I just want to get your thoughts on this, and this is mostly global, right? Are we looking at, is this the first glimpse of a post-QE world? Right. I mean, that's the question for you, and let me tell you why I'm asking that question. Just a couple of things, right? Stunning fall in the prices of Greek bonds over the last couple of days. Spain, the Spanish market, equities are down about 7% in the last 2 days. Very sharp correction in high-yielding bonds and things like the iShares high-yield corporate bond ETF. It's denominated in US dollars. Very sharp correction there. Oil prices, of course, are down 25% in the last since June. Emerging market, MSCI Emerging Market Index is down 11% from the start of September. MSCI World Index is down 9%. The S&P 500 is down 10% from mid-September. UN World Food Price Index is down about 10% or so since the March highs. Soybean corn down 25% since June. And of course, the US 10-year was driven below the 2% mark before it rebounded, Rohit. What do all these things sort of tell you?
Yeah, what all of this tells me, and I think we've been looking at it for quite some time. In the last couple of interviews, what I was saying was that the global markets are going to become more important. People were not looking at what was already happening. I think a lot of these markets which you just mentioned started to sell off well ahead of even the US market or the selling that we've seen in India, which is probably lagged the rest of the world, and it's still lagging by a huge margin. We saw the Australian market top out somewhere early in September, and I put out a note that this index is already down 5-6%, breaking so many levels. And then you saw Greece and Spain happen. So I was not sure what would be the issue in Greece, but I wrote about that Greece could become the next problem and things could come back, and that's what has happened. So essentially what we are seeing is the return of a global equity bear market. This is what I think. I think the US market was forming an ending diagonal structure for the last 9 months, and that completed on the 21st of September. And from there, we've seen consistent selling on the US, which is slowly spread to even other markets which were holding out. And within that, I think India is still holding out, because just like you said, the MSCI index, US index are all down, a good 10%. And we are still not down 10% from the peak. So I don't know if you think that India is a low beta market or a high beta market. I think it's among the high beta markets. And right now we are not really responding, and we should eventually catch up with that indicator. And if we do, then from the peak, 10% means you end up closer to around 7,300, which I think is a major key support for a lot of the longer term investors. They're looking at market dropping there being a very good buying opportunity. I'll keep my fingers crossed, let it come there, and then we look at it. But my current sense is that everything that you've said indicates that we have started what is a global equity bear market that could last for maybe the rest of the year. For the next 12 months you could be in that. There may be up and down moves, but you would be generally in a downward trend for the rest of the year, is my sense looking at global equities. And what you've seen in the bond market, in the US bond, the yields, we discussed this last time, that they tend to be inverted, which means when US markets fall, money chases bonds, and therefore yields actually come down. And I've also been expecting that rates will actually go up, and that might happen in the next phase. So essentially, when you'll see the US market make its first bounce back, you'll probably see selling in US bonds again. And there will be an inflection point where when yields actually start going up, and the markets are rebounding, at some point of time, the markets will not be able to take the pressure of higher yields, and that's when you might see for some period of time a direct correlation between rising yields and the falling stock market, which means falling bonds and falling equities. But right now, those two asset classes remain inverted. Every other asset class, equities, commodities, all of them have seen sharp selling take place.
So we basically get to about 7,300, right, Rohit?
That's the first number, I think, that everyone is now looking at.
I don't know, everyone, most
technically,
people. Well, technically, yes.
Yeah, technically everyone would be looking at 7,300. Most of the others might be hoping that you won't fall below 76.
No, and you said at 73, what, it would be a buying opportunity?
What I'm saying is 7,300 is an important level to decide whether it's a good buy, because...
But I mean, if you're saying that it seems to you that we've entered a global equity bear market, Rohit.
Yes.
Then
7,300 should not hold. So I think that's the test. By sometime after Diwali, we should be testing that, and that should give us an indication whether the Indian market is doing anything extraordinary, holding out against the world markets or not. But like you said, if you have a global rout, then I don't know how that level should really hold.
Yeah, no, absolutely. So the thing to do is what? I mean, if you are trading, the thing to do is sell the bounces, the big bounces, right? Is that what you would say?
Definitely in stocks, what I found more useful in the last month, and probably even you can see it happening today, is that, while I would want to be bearish on the index trade somehow has not played out because a lot of money that has moved out of the Indian economy-based stocks has chased the global growth or defensive stocks, which means IT, auto, and pharma. And this has kept the index from really falling down. Even yesterday or today, ITC is helping add up points to the index. So we're really lagging far behind what the global markets have done. But what has helped is most of my views on stocks have been on the sell side, whether it was DLF, whether it's HDIL in reality, the metal sector, Hindalco, Tisco, Steel Authority, whether it's, so all of these sectors, the other sectors, PSU banks, they've all given a lot of opportunities on the sell side, and they continue to give opportunities on the sell side. So the focus really, till the index, starts giving us those big moves, which it appears to do every time like it did yesterday. But again, today we are not seeing a serious follow-up yet on the index. Definitely focus on stocks because you are getting moves on stocks today. For example, I would say Tata Motors broke its low of the last 2 days. And has become, and the auto sector, which was one of the best performing sectors, I think has topped out in the last week. And probably you'll see continued selling in auto stocks in the days ahead. So focus on stocks as they develop their downside. Eventually the index itself should show it. But for some reason, like I said, it's still not showing the kind of nervousness that we've seen around the world.
The index somehow, according to many, Rohit, has been managed. And it's not fallen that much, but I mean stocks, yes, you can see that pressure clearly. Rohit, thanks very much for your time. Great talking to you, and good having you here as always with that perspective. Rohit Srivastava, fund manager at Sharekhan.